S&P 4200, here's what you need to know before the bell. Today's blog post on the website is talking about this particular setup for a rally in the markets that could take the markets back to 4200 on the S&P. Now, that certainly seems a little bit far-fetched given everything we've got going on in terms of banking crises and economic slowdowns, etc. But nonetheless, the technicals have improved as of late, and we've talked about this. When we look at the markets over the last couple of weeks, despite the FOMC hiking interest rates and the banking crisis going on with Silicon Valley Bank, markets have continued to march a bit higher here. And again, the bullish kind of aspect to the market remains bullishly biased. We've now gotten above the 200-day moving average, the 100-day moving average, the 20-day moving average. So again, lots of support for the market just below current levels. The only real resistance to the markets right now is the 50-day moving average, which is sitting right at 4,000 on the S&P. So if the markets can get above 4,000, there's actually very little to stop the markets from rallying up to at least 4,100, if not 4,200, which is pretty much close to those previous tops in the markets back in February. So when we take a look at the market itself, that dynamic, we've just triggered a buy signal from a fairly low level that's helping giving some lift to the market short term. Markets are not overbought on a short-term basis either, suggesting there's still enough fuel there to move the markets at least a bit higher in the short term. Now, when we take a look at this market pattern that's developing, again, we have these rising lows over the course of the last few trading sessions and this declining top that started back in February. So we have this consolidation pattern within the markets that the markets have been now grinding out here for the last couple of weeks. A move above that 50-day moving average, again, breaks this downtrend line. That's also going to help lift the markets back towards that 4,100 level. That would be our first kind of target here for the markets to move to. A push back here to 4,100 seems to be the most obvious and likely choice for prices to get to in the short term. Again, we'll take some profits at that point. We've increased some exposure here recently because of this buy signal. But again, once we trade up to this level, markets move back into overbought conditions. Once our buy signal becomes a bit more elevated, we'll start taking this money back off the table. Again, this is going to be a year where just kind of navigating this volatile market is probably going to be a consistent course of action for the rest of this year as we begin to navigate whether or not we have a recession, whether or not there's more banking crises, whether or not there's a slowdown in economic activity, a drop in inflation, whatever it is. Markets are going to be trading off this news on a regular basis. So this year, unlike last year, we're going to need to be more nimble about taking advantages of rallies as they occur and avoiding the subsequent downturns. But for right now, markets are turning more bullish. We'll see how this works out, but we'll keep you up to date as markets develop. I'm your host, Lance Roberts, and that's what you need to know before the bell.